You know, timing is everything. Here we are in early March of 2023 when we're doing this interview. And 2022 was it was quite a storm. The market was down about 20%. And now in 2023, it's been a terrible week this week in the market. But, you know, the majority of people that listen to our show and to our program, they're in the 50 plus category. So let's start off by talking about risk. Why is risk such an important topic when it comes to someone in the 50 plus group or someone that's about to retire?
Well, you know, everybody thinks retirement's about how much money you have in your 401k or the value of your house, and that's really not it. The secret to success in retirement is two things. Number one, you want to have increasing income, and number two, you want to manage risk. And one of the risks that people forget about is a risk called sequence of returns risk. You know, the market was down big last year, and really the bonds were down more relatively than stocks. It was the worst year ever for bonds, and so it was one of the worst years ever for the 60-40 portfolio. And so you've got people out there who they got brokers, and I always say, you know why they call them brokers, because you're broker than you were, 6 months ago. But they got these brokers, and then they're taking money out of a portfolio that's going down, and that's a recipe for disaster. You know, people think that the riskiest time to invest in the market is when you're older, like in your 80s. The riskiest time to invest is not when you're 87. It's when you're 57 to 67. It's those years right before or right after retirement, because if you lose money in that box, it can devastate your entire retirement. Well, guess where those 78 million baby boomers are? They're all in that box. And so you don't want to take money out of a declining portfolio. Okay. Now, you've got many ways that you can help them with that. There are products that will do that. But even if they don't want to use certain products, they can use what's called a buffer asset, and then they can have something that never goes down and take money out of there when the markets are down. And so there's many ways. You're the save money expert, but as you know, you can protect people from never running out of money, which has been the number one concern of people, by the way, ever since there's been people and there's been money.
Yeah. Absolutely. You mentioned sequence of returns risk. I write about that in my book, Bulletproof, the Safe and Secure Retirement Income Plan, and piggybacking on everything you've always taught me, talking about why that's important. So talk a little bit about sequence of return risk and how that actually works.
Okay, well, it can sound complicated, so let me try to make it as simple as I can.
Yeah.
If you retire and you have an investment portfolio and you're withdrawing money out of that portfolio, and the first 2 or 3 years of your retirement, the market goes down, 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 math and science says you are highly likely to run out of money. Conversely, if you retire and you're taking money out of a portfolio in the first couple of years of retirement, the market goes up, up, up. Math and science says you're highly likely to be okay in retirement. The problem is none of us knows when those years will go up or when they go down. We know it goes up about 70% of the time, it goes down about, or 75%, it goes down about 25%, but we never know when those years are. And so that's why it's so important you can manage that risk simply by having sources of guaranteed income cover your basic living expenses. Because, see, Brad, I can weather the ups and downs of a market if I'm not taking money out of that portfolio. I just wait, right? But
Right.
if you got all the money in the portfolio and you have to take money out because that's where your money is, that's where people get in trouble. And so I'm not saying don't be in the market. I'm not saying don't have investments. I'm saying have it in the right place in the right amount and have some guaranteed income in the right place in the right amount. And by the way, that's what the research of all the top PhDs around the world who've studied retirement say. These are not my opinions. These are mathematical, scientific, and economic facts. And now you got companies like Ernst & Young, one of the top accounting firms in the country, just did a white paper and showed that the best investment portfolio doesn't just contain investments. It contains investments, life insurance, and annuities. And this is the top accounting firm in the world because they showed they did a test of 100% stock, 90% stock, 10% bond, 80-20, 70-30, 60-40, 50-50. And then they went back and put in some life insurance and annuities in each of those portfolios. And the portfolio that did the best had all three. So I think you can agree. You need some investments and you need some protection products in there as well.
Boy, Tom, you said something great there, and I know this is true for both of us, but I own stocks, bonds, mutual funds, annuities, life insurance, real estate. I have a little bit of everything, and as a holistic planner, that's what we want. We don't want all of the eggs in one basket for anyone. You need some of all of it, but boy, you sure don't want to be in a rising tide when a major crash comes and pulls out everything from under you and you find out you didn't have any trunks on. There's got to be some protection there. And so we're going to talk more about that.